All right, so tonight we have another presentation. So the first course was on budgeting and how to stop the debt spiral, how to get rid of debts. I hope that you were able to work on your budget. So I'm going to show you a little bit what I plan, what my budget looks like. So let me share my screen with you, and you let me see. You let me know if it's legible enough, right? Is it good? Can you read?
Yeah, we can read on the computer. Yes, I don't know on the phone.
All right.
Can you
Well,
can be a little bit bigger, maybe?
let me put it a little bit bigger here. All right. Let's see. There you go. All right, sounds good. So basically, this is a sample copy of my budget. Of course, I removed the actual numbers just for you to give you an idea of how I plan my budgets. So every month, as you see here at the bottom, I have a budget for every month. For the past three or 4 years, we have different budgets every month. But I basically copy from one month to another, and then I change and tweak if I need to do any special expense. So here I have my projected salary, Julie's projected salary, my wife, the government's benefits for the kids, if I have any tax return, if I have any gifts, and any reimbursement. If I lend somebody some money and they give me some reimbursements, then of course that's tithes free because I have already paid tithes on it, right? So this is my budget. So projected and then actual, right? Usually my salary is fixed. Julie's salary can vary a little bit, but usually it's pretty much the same, right? And then this is automatically calculates the tithes and offerings. And let's say, for example, if I enter $1,000, you see tithes 100, offerings 100. I like to give 10% tithes, 10% offerings. And then I enter the actual amount. Once I sign the check or once I send the money, then I enter the actual amount, and that's it, right? So now these are my income. These are my expenses. So first, of course, God is first. So tithes is first. After that, I have my mortgage. We just bought a house about 1.5 years ago. So we pay $1,300 a month. Then I have taxes. So this is basically my taxes, land and school taxes combined, divide by 12. So every month, I pay myself $180 because, as you know, taxes is every quarter. So I put on the savings account $180, and then when I need to pay taxes, I take it from that savings account and just pay the taxes. House phone, internet, and my wife's cell phone. I put $20 aside for lawn and garden care every month. So this is a fund. So what I call a fund is either I put it in a separate savings account, or I have an envelope at home and I just get the cash out of the bank and put it in an envelope. There's an envelope for lawn and garden care. There's an envelope for electricity, an envelope for maintenance supplies, an envelope for improvements, an envelope for repairs, and so on and so forth, right? Actually, for heat, electricity and heat, I have a savings account because it's easier to just leave it there at the bank. But for those small, expenses, I just withdraw the cash and I put it in an envelope that I keep with me. Then groceries for a family. We're a family of 6, so we spend $700 a month in groceries, and so on and so forth. And so every time I have an expense, this is synced with my phone and with my wife's phone. So every time we go to the store and I spend, let's say $10, I enter $10, right? And it tells me I have $690 left for the month, right? Let's say next month's next day I spend another $20. I type plus 20, and that's it, right? So every time I have expenses, I type plus my expenses, and so on and so forth. I have a closing budget also because, as you know, kids grow up, and so we save money for everything. There are some funds that are zero. For example, laundry or dishwasher for this month. I have saved enough money to buy a laundry or dishwasher for a couple months. So I don't need to save necessarily, $1 or $2 a month. It would be too much of a hassle. So I save like, $30 for laundry. And then when I run out, then I'll save again because I don't buy dishwasher products or laundry products every month. Barber, now we do it at home, so I don't need any more that budget. Dry cleaner and so on. Gas, car repairs, car insurance. Car insurance, this is my actual expense every month, so it's taken from my accounts. So as soon as it's taken from my accounts, I enter 88.28. That's it, and it's and so every time. So at the end of the month, I look at all of that, and it should be zero, right? And so all of that, we have a lot of expenses. And then at the end, basically should say zero. All right, so let's see at the beginning. All right, let's say I got $1,000 and I look at the end, you see, I still have $836 to put in different categories. So that's basically how I work my my budget. And so it's very easy to run every month. If I need to change numbers, I can change it, but I have to make sure that at the end, this is still zero. My projected expenses for the whole month have to be zero. So I cannot plan to overspend. That's my rule. If I want to spend more in groceries, for example, or repairs, let's say I want to spend $100 in repairs, I want to paint a room or something, then I have to, find $50 somewhere else. So I'll spend $50 less in groceries, for example, right? So I have to, right? I have to balance it out so that at the end it's still zero. All my money has a name and has an assignment, and whatever else I have that I don't assign, I will put in savings, right? So that's the plan I have. Now I hope you're able to do some kind of budgeting. This is where we can talk at the end of the meeting if you had any difficulty doing your budget. But this is extremely important that you write down your budget before the months begin for the whole month. You spend virtually, you have to spend your money on paper. Every cent you have, spend it all on paper before the months begin, so that you know your plan. You're planning your months basically. And of course, you may have some surprises during the months. That's why you have an emergency fund, right? But normally you should not have too many surprises in the months. Now, this is something we didn't talk about, emergency funds, and this is my next step. Once, while you're paying off your debts, you should never have a big emergency fund. I told you about that. I told you, you need to, if you have a big emergency fund, use it up to $1,000. Just keep $1,000 in the bank. $1,000 is enough for most emergencies. If your car breaks, if your washing machine breaks, our dishwasher broke this week or last week. Our dishwasher broke, so we have to call, for repairs. The pump is broken. So, so $1,000 is enough for small emergencies while you're paying off your debts. When you have your debts paid off, then you want to build an emergency fund, not just to $1,000. You want to build it to 3 to 6 months of expenses. So you take all your expenses, you multiply that by 3 to 6 months. So 3 months, if you have a very stable income, very stable job, both you and your wife, you and your husband have both stable jobs. But if you're self-employed, or if your job is not so stable, just keep 6 months of expenses in an emergency fund. So it can be from 10, 12,000 to 30,000, between $10,000 and $30,000. And that's not invested. This is an emergency fund in case you lose your job, right? So if you completely lose your job and you cannot find work for 3 to 6 months, then you're okay because you have a cushion that protects you. You don't want to borrow anymore, right? Borrowing is done. It's over. We'll never borrow anymore. So you have $10,000 to $30,000. It should be enough, to cover most people. And if you don't have any debts, you actually can save that in about a year or maybe under a year, So you have to be aggressive to pay off your debts, very aggressive, very intense. And you have to be very aggressive also to build that emergency fund. Once you have that, then you can relax. All the steps that we'll talk about later on, you can relax a little bit and you can enjoy life a little bit more, spend a little bit more for, enjoying life, going outing and things like that. But until you have debts and until you don't have a fully funded emergency fund, you need to be intense. Now, let me tell you that it makes a big difference when you have $10,000 in the bank and something happens in your life. It's not an emergency anymore. 2 years ago, my car broke down. It was the gearbox or anyways, it was really, really expensive to change and to fix, right? But it was not an emergency. Why? Because I had an emergency fund. So what happens with the emergency funds? I have something, I have a problem, I have an issue. Like, that's okay. I'll be okay. I'll just take it from the emergency fund, pay for it, and that's it. Before, when I had anything happening to the car, I'm like, oh, how am I going to do? My car is breaking down. I cannot go to work anymore. I cannot do this. And it was a nightmare. Now I take it with a lot more peace. And this is what financial peace is about. It gives you peace of mind and you're more relaxed. So it's very important to have a cushion. $1,000 when you start, just to paying off your debts. So you keep $1,000 in the bank or at home in a secure place, easily accessible, and you just pay all your debts quickly. Once that is done, then you save it up to 3 to 6 months of expenses. So it's different for everyone. Some people might think $10,000 is way too much. For example, if you're a student, you don't necessarily need $10,000 saved, but I would say 3 to 6 months of expenses. Now, this once you have done that, and you're now going to start building wealth. You're starting to build your life. Now you're not in the negative anymore. Now you're in a positive. So now your next goal is to start building a cushion for life. You already have a little bit of cushion, which is your 3 to 6 months of expenses. That's already helping you in life, but it doesn't cover for all of the problems. So, for example, if you have, if your mom dies, you need to pay for burial fees, and burial fees can be $10,000, right, or more. It doesn't cover for a car wreck. If your car breaks, car usually are more than $10,000. Your house burns down. I think Sister Claudette had her house, that was, it didn't burn down completely, but, all the smoke came in the house. And so it doesn't cover everything. So that's why you need to have a little bit more risk management. So $10,000 to $30,000 covers most of the expenses, but you also need to have insurance for what you cannot cover, right? So if your house burns down, you should not cover that. Something should cover this. What is it? It's insurance, right? So that's why we talk about insurance now. Insurance covers for the big things that you don't want to pay. You don't buy insurance for the small things you can cover. For example, a flat tire, right? Flat tire is not expensive. You can pay for that. You don't get an insurance on the flat tire because they offer those, right? You don't get an insurance on the TV you buy. Right? Some people buy extended warranty on a TV. Do you know that extended warranties they only cover 5%, like 5% of people actually need their extended warranties. So you have 95% of chances not to use it. So guess what? It's a ripoff. That's how they make money. They push extended warranty on you because they make you afraid. Oh, it's gonna break, it's gonna break. Well, guess what? If you save that money instead of giving it to them, you save that money, you have 95% chances of winning. And yes, maybe you have 5% chances of losing a little bit, but average, never get extended warranties on the small items. Never get it on the car. Extended warranty on the car is not a good deal. Extended warranties on the TV, extended warranty on a computer. It's never a good thing, because if it was a good deal for you and a bad deal for them, guess what? They would lose money on it, right? Companies are smart. Let's say Apple, for example, or Microsoft, when they sell you an extended warranty for your computer, if they would lose more money than they would make, they would be bankrupt, right? So they're very smart, and they know that it costs you more. It's a benefit for them and not so much for you. So they're not going to be bankrupt. They're expert in what they're doing. So don't get any extended warranties on the smaller things. Get insurance on the things you cannot cover, right? So a TV that breaks, you have 3 to 6 months of expenses, you can cover it. It's painful, but 95% chances that you don't have to use the extended warranty. So you can cover that. If you have, again, as I said, the dishwasher that we have, we could have bought the extended warranty, but the extended warranty only covers you 2 years, right? And guess what? Our dishwasher is older than 2 years, and now it broke after the 2 years. So we would not have needed it, and it would have been a waste of money. So never, never, never get any extended warranties. Now, insurances are for the things you cannot cover. You cannot cover for your house. If it burns down, or if there's the fire, there's a flood, there's hail that destroys your roof. These are big things. You need insurance for your home. Now, if you own a home, you need insurance. Of course, it's mandatory. If you rent a home, if you're a renter, you absolutely need insurance as a renter. It's very cheap as a renter, but you need to get it. That happened to a person I know, that they had they were renters, right? And I know the owner of the house, and he's renting his house, and so the house burned down. And so the owner, my friend, he went to the house there, and he said, thank God it was insured. So the man, the renter, he came to him and he says, well, the house was insured, right? And my friend says, yeah, of course it was insured. And so he said, so the renter said, so when am I going to get my check? And the man looked at him and says, what check? Well, says, because, I'm renting the house. All my stuff, all my furniture, all my clothes, everything I had, it's gone, it's burnt. When am I going to get my check? And the landlord looked at him and says, well, did you have any insurance? And he didn't. And he lost everything. He thought he was insured. So when you're renting a house or an apartment, the landlord has an insurance for his property, but you need to have insurance on your stuff, because if it burns down, you get nothing and you have to start over again. And you should have seen the tears on the man's eyes when he realized that he was not insured. That's terrible. So you need to have insurance on the house, homeowner or renter insurance. Now you need to have insurance on your car. Depending on how old your car is, you might want to look into insurance. The best insurance, shop around. Every year, every single year, you should shop around for car insurance. I call at least 5 companies every year, 5 different companies beside my own, and I ask for a different quote every single year before the date of renewal, because one year your company may be cheaper, the next year another one may be cheaper. So I'm not faithful necessarily to one company. They all insure the same. They're all the same. So I pay less when it changed. You need an insurance on your disability. So your greatest source of income comes from your work. If you're able to work, you're able to get money, and you're able to, save, pay your things, and so on. What if you're not able to work anymore, right? You're disabled, you fell from the roof, and you're disabled. You need to be able to find a source of income. And if it's not coming from your work, you need some disability insurance. So disability insurance is also very cheap, depending on your type of work you do. Most jobs are considered low risk, especially if you work in an office or something like this. Now, if you are a skydiver, that would be a little bit more expensive, right? If you're traveling the world and going to places that are dangerous, that might be a little bit more expensive. But usually for most people, disability insurance is very reasonable. So get disability insurance. There are different kinds. I'll let you work with your insurance broker. I highly recommend you to go with an insurance broker, and because they are able to shop among several companies. When you go for an insurance broker, make sure it is not a captive agent. What I mean by that, you have two kinds of insurance brokers. You have the first kind works for one company. They only work for one company, and they only shop the prices from their own company. That's called captive agents. Now the second one is independent broker, insurance broker. So the independent insurance broker, they shop around, to all the companies around, all the reputable companies that are established, and they give you the best quotes for you, right? So, and it's free for you. They actually get commissions, but you don't pay anything extra because they bring clients to the company. So that's how they get paid. So, so it's completely free for you to get an insurance broker, and they'll shop around for that. So disability insurance is important. Now, make sure when you talk with them, because they will try to sell you other types of insurance. So you have to be very used to, very knowledge. You have to learn how it works. So disability insurance is important. Now, long-term care. Have you heard what long-term care is? Basically, long-term care insurance is after you're 60. So after you're 60, you might want to look into long-term care insurance. So if you have to go to the nursing home can be very expensive. So you might want to look into long-term care. Some long-term care insurances cover for good nursing homes, or sometimes the best ones actually offer you to stay home and have a nurse come to your home and take care of you, right? So so that would be the best way, right? So long-term care insurance, you should never get it before 60, but after you turn 60, you should look into that, because most people they have a chance of going into long-term care, nursing homes and things like that. Once they go into nursing homes, usually they stay 4 to 5 years in a nursing home, and then they pass, right? So don't get too much of insurance. Look at the statistics, get educated, ask your broker their recommendation, but never get it before you're 60. You never need it before you're 60. Nobody needs it. You can count on like 0.5% the people that are younger than 60 and that need long-term care, and needs to go to that. Then the next insurance you might need is identity theft, but not necessarily. This is in Canada, we don't have as much problems with identity theft insurance problems. You have to have more in the US. So if you don't have that problem, I don't recommend to get identity theft protection. But sometimes they get you that insurance for free when you work, at your company or things like that. Now, one thing that is extremely important is life insurance. So let me explain you that. Most people that try to sell you life insurance, they are crooks. Let's say it like this. They're crooks and they're trying to get your money. So the Bible tells us to take care of our own. We need to care for those that love us and those that we love. This is very important, to take care of your own family. So if you have any dependents, what I mean by dependents, it can be children, it can be older parents that you take care of, or it can be your partner, right? Life partner, husband or wife. If you have anyone that would suffer financially if you passed, then you need life insurance. So for example, if I die, I bring most of the income in my house. So if I die, my wife needs to hire, she needs to quit her work because she can't work anymore. You know, we have 4 kids and they're homeschooled. So she needs to quit her job and full-time take care of the house full-time. So she needs a way to replace my income and her income that she would have to lose. And for me, if my wife dies, then I have to hire a nanny. I have to hire a cook. I have to hire, you know, a house cleaner and so on, because my wife is doing all of that, right? And so that has a cost. So basically, you want to provide a way for income in case you pass. And you know what? Guess what? We all die, right? One day or another, we will all die, except when Jesus will come. And when Jesus will come, guess what? We won't need any money or any insurance anymore, you know? So we'll have all the money in heaven. So, but my point is, you need to plan for your death. It's not bad luck to plan for the time when you will not be here anymore. It's not attracting bad luck. It's actually wise to plan for that. So if you have anyone that depends on your income to keep their lifestyle in case you pass, you need insurance for them and for you. Now, there are 2 types of insurances, and this is what I wanted to talk a little bit with you today. 2 types of insurance. One is terrible and one is extremely important. So the main types of life insurance is term insurance. And the second one is called whole life, or sometimes they're called permanent. Whole life or permanent. Term or whole life. Those are 2 kinds. Now, term insurance is like your car insurance or your house insurance. You pay every month, a small amount, so you pay every month. And if you die, they give you some money, or they give your heir some money for them to take care of your burial costs and to replace your income. Term is the way to go. Whole life, on the opposites, whole life is a very, very, very bad product. If you have whole life insurance, I'm really sorry for you because it's terrible. Okay, what whole life is not a good product. They're combining 2 things. They're combining term insurance with a savings plan. The savings part is really bad. It has a low interest rates, usually 3 to 5%, which is very low. When we'll talk about investments, you'll see that 3 to 5% is extremely low. It's terrible. So they associate a savings plan to your insurance. And so the savings plan is bad. You overpay, you actually pay 20 times more than in whole life than term life. And when you die, they only pay the face value of the policy and they keep the savings plan. So this is a very, very, very bad plan. This is a very, very bad plan. So when you have a friend or a family member, or usually, it's friend or family members that come and says, hey, I want to sell you some insurance, life insurance, be very careful about this. Usually it's a whole life policy, which has a savings associated to it. Now I'll talk about investment in the future. That will be a class number 4, how to invest. But you should never combine two products. An insurance is important. Saving is important, but it should be separated so you can control both. When you combine them together and you make a mix, it's usually obscure, and it's usually insurance companies that want to just take your money. And also they add a lot of extra fees to that. So usually the first 2 years, you're hammered with fees. And if you stop your insurance during the 2 years, you have zero money left in that insurance fund. So term insurance is the way to go. The way terms insurance work is you select a plan for specific numbers of years. So 10, 15, 20, 25 years, 30 years. And you select the time period you want to be insured, and the amount of the policy. For example, for me, I'm planning to have my house paid off in 15 years, because when we'll talk about home buying next class, we'll talk about home buying. I'll show you how to pay off your home in less than 15 years. So in 15 years, for sure, my house will be paid off. My kids will be grown and gone for most of them. My youngest one will be 17, so the other 3 will be gone, and maybe the one that's 17 might be still home, but the other ones will be gone. So I'll have one dependent, and I should have enough savings to cover, in case I die, to cover my wife's income and all the needs in the house, in your home. So if you follow that plan, in 15 to 20 years, depending on how old your kids are and how old you are when you start your plan, 15 to 20 years usually covers for most people. You have no debts, your house is paid off, your kids are grown and gone, and you have savings of at least $500,000 in 15 years. So if I have my house paid off, my kids are gone, and I have $500,000 in the bank, do you think my wife would be okay if I die? Yeah, she will be. She will be okay. And when I will show you about investments, that $500,000 will produce enough income for her to live comfortably. So this is the plan I want to explain you. So for most people, 15 years of term life is enough. If you're not sure, just take 20 and get a quote for 20 years term life insurance, and you'll see that it's 20 times cheaper than whole life insurance. So it's basically, the price of a pizza every month. If you're young and healthy, it's about $20, $25 maybe a month. And for you, $20, $25 a month for your partner. Now, I recommend the face value of the insurance, I recommend that it be 10 to 12 times your income. 10 to 12 times your income. For example, if your income is, let's say, $50,000 a year, you get $500,000 of coverage, $500,000 to $600,000 of coverage. So that in case you die, they pay you that amount, non-taxable. You put it in investment. In the investment, I'll show you how to invest later on. The investment will produce about $50,000, $50,000 to $60,000 cash, non-taxable income a year. So it will completely replace your income if you pass. So that's the idea with life insurance. You don't want to go with the other type of insurance, which is whole life or permanent. If you have whole life insurance or permanent life insurance right now, very quickly get a quote for term life insurance. And once it's in place, then you can cancel the whole life. So don't cancel before it's in place. The term life is in place because you might die between the two, between the transition. But absolutely cancel your whole life policy. Even if you have it, especially if you have paid for it since you were 18. Some people pay for it since they're 18. Some people, their parents have paid for it when they were babies, and they have paid for it 20 times what they should have paid for it. And they've lost money. So if it's a bad plan before, it's still a bad plan today. So cancel it as soon as you can. And cash that money out. If you have any money in that whole life policy, cash it out and invest in the plan I'll show you in 2 weeks. Invest it there, and you will see that it will more than double in a very short amount of time. So that's basically the different types of insurance. We'll have time for a question at the end. So if you have any question on life insurance, one thing I wanted to mention also for those that are interested to know, those that believe in Ellen White and her writings, some people are a little bit scared of life insurance because they have read that Sister White was telling us not to get life insurance, and this is why I can study with you if you're interested in that. The type of insurance that existed at Sister White's time was actually whole life insurance. And it was extremely risky, and people would just lose everything, or they would commit suicide so that their wives would get everything, so that they would get out of poverty. So that's why it was the wrong type of insurance. Term life insurance is like a car insurance. It's like a house insurance. You're just paying every month. If you don't die, or, you don't get anything. If you don't have a car wreck, you pay every month, right? You pay for insurance every month. You're hoping you don't have a car wreck. But if you do, then the insurance pays for it. Same thing for life insurance. You pay every month. You don't expect them to cover anything except if you die. And then when you die, then they give the money to your heirs. So it's very important to plan your next years. Most people that are poor only think about next week or next month, the end of the month. How am I going to do until the end of the month? That's what they think. They think short term. They have a short vision. People that are rich, it's not because they necessarily have better education, or it's not because they any special skills they have. It's because they plan for a long term. So plan in your mind, plan for 15, 20, 30 years from now. And that's how your goals have to be long-term so that you can see your future ahead of you. And as I said, if Christ comes back before, which I hope he will, if he comes before and it interrupts our plan, it doesn't matter. We don't need money in heaven. There's no problem. If you have a big pile of money on earth, I'm happy to leave it and go to heaven because I don't care about the money here on earth. It's only if I stay on earth longer than expected, because the Lord is not slack concerning his promise. He promised he will come back soon, but he promised that 2,000 years ago. So I believe the events tell me that he's coming soon, but I don't know how soon. And you don't know either. And nobody knows. So I plan as if I'll die here on earth, but I work for God as if he's coming tomorrow. That's basically my plan. So that's about insurances. Now, the second part of what I wanted to present you today is about college and car buying. So very quickly, we don't have a lot of time left, but college planning starts when you start having young children. So when you have younger children, you start thinking about college. College in Canada is not as expensive as in the US. We have many ways to save for college, and there is an actual fund in Canada where the government sponsors your kids. So if you put some money, the government, federal and provincial, matches it to 30%. So you put $100, the government gives you $30, right? So it's amazing. It's like 30% in return. It's like a savings account with 30% return every year. So it's very good, and you should look into that if you have younger children. If you already are close to college, you're 17, 18, considering college, your best bets, you have three things to think about. First, the most important thing is college selection. You have to go to a college that is as cheap as possible. It doesn't matter where you graduate. You don't need to go to any private college. You don't need to go to private university to get a degree. You need to get the degree where it's the cheapest. You know, some people want to be doctors, and they think that it matters where they get their degree. You know, so they go to those private universities that are very expensive, and they get, you know, their degrees, and they're $50,000, $100,000, $200,000 of debts when they graduate. And guess what? When I go to my doctor, I don't know where they have studied. It doesn't matter to me at all. When you go to your doctor, do you know where they have studied? Not at all. You only know that they have graduated, they're doctors, they're certified, and they're good, you know, enough to take care of you, right? So as long as you have your degree, it doesn't matter where you get it. As long as you have your degree, you're good. So take it, go to the place that is the cheapest you can afford, or you can get. The second point is get as many scholarships as possible. Apply for scholarships. So if you're close to you have no savings and you're close to entering university, or you're already there, apply for scholarships. You have many scholarships to apply. You can apply for. And so if you apply for one scholarship a day, you have to usually write an essay or something like that. Write as many essays as you can once a day. And if you get one scholarship that is $500, you know, they give you $500, you basically worked maybe 1 hour and you're paid $500 for 1 hour of work. So it's worth it. And sometimes it's 500, sometimes it's 3,000, sometimes it's 10,000 scholarships. I know I know the daughter of a sister here in Canada. She went to all through her university classes, and she's now in her doctorates, and she had scholarships all through. She did not pay a cent. The scholarship paid for her room and board, for the tuition, for the books, and everything was covered because she applied. So that's very important. The third thing is you need to work. When you're in school, you need to work. Work has never killed anybody, right? So study. Usually students, they don't study, you know, 40 hours a week, right? So you maybe study 30 hours a week and work 10 to 20 hours a week. And then don't aim for the low paying jobs. Try to aim for the higher paying jobs. Like instead of working at, at McDonald's or Burger King or something like that, try to aim for jobs that are paying a little bit better. Housekeeping, nanny, being a nanny, like taking care of kids. Or if you're an expert with computers, you can do website development, like small websites for small companies, things like that. Those jobs are paying usually double or triple what you could get working at Tim Hortons or McDonald's. So or raking leaves. You know, now it's the fall. You can offer. You can go to your neighbors and ask them if you can rake their leaves. In the winter, snow removal, right? So those are jobs that pay a little bit more per hour than working in a fast food restaurants. So those three elements: choosing your school well, applying for scholarships, and work. And you should be able to graduate debt-free. Never borrow money for school. You will always regret it. You're able, especially in Canada, you're able to study without debts. Never borrow money. And usually when the government sponsors part of your school, when you apply, they give you loans and they give you scholarships. So it's a package. So you have to take the loan. Take the money from the loan, put it in the savings accounts. As soon as you graduate, just send them back, right? And don't use it, don't spend it, because you will always regret it. Now, the last point was about how to buy a car. Very quickly. So the way you buy a car is you never buy a car new unless you're a multimillionaire. Never, I repeat, never buy a new car until you are a multi-millionaire. New cars, they drop in value. It's an asset that you buy, but it drops in value. So usually a new car is about, $20,000 to $30,000. It's like you put $20,000, you leave it there, and after a year, it's 15. And after a year, it's 10,000. And after a year, it's 7,000. Guess what? In 3 years, it lasts, around 65 to 70% of its value. So why would you buy a new car that drops in value? It's like putting your money in a bank, and instead of earning interest, you lose. It's stupid. And on top of that, most people that buy a car, of course, they don't pay cash for it. So on top of that, they pay, fees, right? Interests, because it's a loan. So they pay fees for the loan or interests, and the value of the car drops. So it's very, very, it's not wise to buy a new car unless you're a multimillionaire and you don't care, you don't mind, it's like losing money. It's okay. You can throw money out the window. So basically when you drive off your new car out of the parking lot, you already lose $5,000. If you want to sell it right away after buying it, one day after you buy it, if you want to sell it on the market, you lose already a lot of money. So it is not wise. It is also not wise to lease a car. Leasing a car, some people call it fleece. It's a fleece, right? The fleece is like when the sheep are shaven, like when you cut the hair from the sheep, right? It's a fleece, right? So it's like they cut your hair, they take all the money from you. Leasing a car is the most expensive way to finance a car. It's the most expensive way. That's why it's pushed on you. It used to be, back in the days, it used to be that you could buy a car and you have a regular, loan. Now, 80% of the people that buy a new car, they actually lease it because it's like renting it, right? And it's like they push for it now because the car companies make a lot more money there. So it's not wise also to lease your car. If you want to buy a car, buy a 3 to 4 years old car, maybe 2 to 3 years old car. The car has already dropped 50%. So the first 2 years is where you drop the most value. After 2 to 3 years, it drops value every year, but a lot less fast rates. So for example, when I first came to Canada, I bought a 10-year-old car. It was excellent. It was a good car, working well. I had a few repairs to do on it through the months, through the years, but I didn't have any repairs to do at the beginning. And it was fine. It was reliable. I paid $2,000 for it. 3 years later, I sold it for the exact same price, $2,000, 3 years later. So it did not cost me anything except a few repairs, normal maintenance, but that's it. So, but if you buy a brand new car, 3 years later when you sell it, it's half the price. So never buy a new car, never lease a car. If you have, actually, that a new car or an old car, they take you from point A to point B in the same way. You don't need a fancy car to take you from one place to another. You just need a working car. And a $2,000, $3,000, $4,000 car take you as well from point A to point B as a $20,000, $30,000, $40,000 car. Some people are not wise. They go ahead and they borrow money or they lease a car, $30,000, $40,000 worth, and they wonder why they stay poor all their lives because the money drops, the value drops. So that's one way not to lose money. So you don't want to lose money. And if you have a $5,000 car and you need a few repairs, no problem, fix it up. You'll still spend less a year in repairs than you would in a new car in the value drop. All right. So a $30,000 car will drop in 1 year, will drop $10,000. If you have a $5,000 car, You will never fix it up for $10,000 a year. You can do a lot of repairs for that price. So don't buy new cars. Don't lease a car. Just buy the cheapest car that would work and that can take you from point A to point B. Now, some of you don't need cars. That's even better, right? Because cars are a money pit. So if you can avoid it at all costs. So that's all I wanted to talk about today. And I will open now the conversation for discussion. So do you have any questions about insurance, about car buying, about college? Any question? Maybe about your budgets?
Yeah, there was something that came up when you were talking, but now I'm trying to remember what it was, but it was to do with life insurance.
So do you have whole life insurance already?
I don't have life insurance right now. I used to, okay. And I stopped because I thought I didn't need it. Okay. And that's why I didn't continue.
Well, this is a question. Do you need it? So you need to ask yourself that question. Does anyone depend financially on you? Like if you had zero income, would your partner, your husband, because I know you're married, would your husband be fine financially? Would he be able to pay the rent, the food, everything else? Or would he be in trouble after a couple months?
Well, it might be in the sense that if he gets sick and then I'm not sick, in that way, I suppose it would be a problem. So when you were talking about term insurance, you were said something about term insurance that it was better than whole insurance. Yes. But don't get life insurance. So explain that.
No, I said you should get life insurance.
Okay, you said
whole life.
Okay, I understand. Okay.
Right, so only term life insurance.
Okay.
Now this is life insurance is only in the event of death. It's not if your husband gets sick. If your husband gets sick and cannot work, you need disability insurance. That's the type. Disability insurance is if you're not able to work anymore. Yeah. So you fall from the roof, you have a heart disease, you have a liver transplant, and you can't work anymore. This is disability insurance. So usually disability insurance doesn't cover for the first year or for the first 6 months. They don't cover anything. And after 6 months, then it kicks in and they're paying you a monthly payment, basically, right? Some do it for 5 years, some do it for your whole life.
So can you get this kind of insurance from the bank, or do you have to get it from somebody who's
an insurance broker?
Yeah, okay.
Yeah. So disability, that's not very expensive, especially if you work in an office. That's not very expensive. Like I would say maybe $10-15 a month.
Okay.
It's not expensive. And it covers in case of health problems. Now, this is if you're healthy already. If you're sick, then, it might be more expensive because they are expecting you to be, more sick as you age. So you need to get a quote, look into that. But but that's very important. And life insurance, if you have a partner, they depend on your income. So you should get life insurance, term life insurance.
Term life insurance, yeah.
Until you're able to have a savings that's big enough to cover it. For example, I don't have $500,000 in the bank right now. That's why I need insurance. But in 15 years, I'm hoping I have $500,000 in the bank. That's my goal, right? So in 15 years, I won't need insurance anymore. That's why I got a term life insurance for 15 years. So that in 15 years, I'll have $500,000. My house will be paid off. I don't need insurance anymore. I'm self-insured. In case something happens, I don't need insurance anymore. Julie will be fine. My wife will be okay.
I have another question. This is the question I had. Okay, some people, when they buy a house, they say, well, I'm not going to pay for this house completely. After 10 years, I'm going to sell this house and buy another one.
Mhm.
So how exactly does that work? You know, that you're not finished paying the house, but now you're considering, you know,
Mhm.
buying different house and selling the one that you have, not finished paying.
That's fine. So we'll talk more when we talk about mortgages and things like that. But just to answer your question, mortgages can be transferred. So so mortgages are not necessarily attached to your house. So for example, you borrow, I don't know, 200,000, 300,000, and then you're halfway through the payments. Let's say after 10 years, you're halfway through the payments. You sell your house and you buy another one. The mortgage will be transferred. The remaining part of the mortgage will be transferred on the new house. So you still have to pay the rest of the mortgage or the difference of the mortgage. So, for example, if you have paid $200,000 down on a $300,000 mortgage, you still have $100,000 to pay. Right now, if your second house is a little bit more expensive, you have to renegotiate your mortgage, maybe add a little bit more to it, but you still have that $100,000 to pay off. So it's no problem. You can very easily do that, buy and sell houses regularly. That's no problem. I recommend not to sell your house before 5 years. So if you're planning to flip houses, except if the market really went high, you know, like really went up, like the value of your house really went up. But for regular people, if you have a house, stay a minimum of 5 years there in your house, because just the cost of moving, the cost of paying, you know, movers, paying taxes, paying for the lawyer fees and all of like bank fees, it's kind of expensive. And so usually it's good to stay at 5 years, except if your market really went high and by selling it, you can make a big profit. Then that's called flipping a house. And some people do it, it's fine, but I don't recommend for most people.
Because some people just like to buy a house, make it all over, and make it beautiful and get a good price and then go to another place. Eh?
Yeah, that's called flipping. If you're able to do that, that's fine. Some people are very handy and they're able to fix their house for low cost and selling for double the price they paid, you know, and that's good and that's great. And then you should do it if you're able to do it. But most people are not able to do that. So if you're not an expert in home renovation, I don't recommend you to do this. Now, if you can, good for you. You know, I know somebody in Ontario. He's been moving, I think, 3 or 4 times in 5 years. You know, so he bought the houses in the right market at the right time. His house gained a lot of value. He sold it. He bought the second one. He sold it again. And just these 2 operations, not even paying the mortgage, these 2 things paid off his mortgage. The increase in value paid off his mortgage.
Oh.
Now the third house, he bought it mortgage free. In cash, you know.
Wow.
So, and as you know, in Ontario, closer to Toronto, prices of houses are, you know, close to $1 million, or, you know, so he was able to own a house $1 million with no mortgage. So sometimes that work, not every times. So if you're not, especially if your first house, I don't recommend you to do this. It's very risky. Your house is your biggest asset. It's the thing you will buy in your life that's the most expensive. You know, if you make a mistake when you buy a car, well, it's a big mistake, but it's still $20,000, $30,000. If you make a mistake in buying a house, it can settle you. You know, it can damage your financial life for good. So be very careful with that. Some people will try to get you in trouble. You know? So don't listen to all the voices that are coming from both sides. You know, I like to go slow and steady. You know, it's better to go slow and build than to get rich quickly. You know, those people that says get rich quick. I'm very careful about that. I'm extremely careful because you know the story of the turtle. How is it? The turtle and the hare.
Yeah, yeah.
right? Who wins
Yeah.
at the end?
The turtle.
That's right. Slow and steady. You know, as long as you keep going, you follow your plan, slow and steady, you will win. The hare goes everywhere, runs everywhere, try to make money here, try to make money there, and at the end of their lives, like most people, they're broke. So I don't want to get, you know, into those schemes, you know, get rich quick and at the end lose everything. I prefer to be very careful, very prudent, and make money slowly but surely, and
It's
have
true.
less risks. I don't like
Yeah.
risk.
Yeah. Yeah.
All right. Was there any question? If there's no more question, then I think we'll end here. How about your budget? Do you have any question about budgeting? Were you able to write your budget last week?
Well, I noticed that you have many, many categories.
Yes.
A lot of categories. Myself, when I make a budget, I don't have as many as that, you know,
I know.
like different ones, eh?
I tend to be very nerdy. So I categorize everything. I go into lots of details. You don't need all those details.
Yeah, very specific.
Yes.
Very specific.
I have a question.
Yes, please.
Hello?
Yes.
Yeah, I have a question. How I can know amount I eat if I spend every month?
How can you calculate how much you spend every month?
Yes.
Write it down. You need to write it down. You need to have a budget and you need to write it down. So when I go to the grocery store, at the grocery store, they give you a receipt, right? So every time you buy something, you have a receipt. So you have to write it down. You can take a piece of paper. You can do it on your phone if you're able to do that on your phone. Put it on a spreadsheet or on a piece of paper or on a book, you know, like yeah, and you write it down and you add it up. So you take all your receipts every day, you add it up, and at the end of the month, you'll know exactly how much you spent.
Yeah, if you do that, yes, you can know. And I don't know why. Sometimes when you don't have money, you eat and you stay, but you don't spend a lot of money because you don't have.
Right.
But when you have the money, you spend a lot that before. I don't know how you can how you can stop to not to spend a lot and you eat good.
You have to be in control. You have to control your money. You need to tell your money what you want to do with it. Your money should not control you, right? So whether you have a lot or you have a little bit, you need to plan it. Plan your months. You know pretty much how much you will get during the months, right? You know your budget. So write it down on a piece of paper before the months begin and write down, I will not spend more than this amount for food or this amount for clothes or, you know, and so on. And so when you know it, you control your spending. But you have to take a little bit of time to do it, especially the first few months. You need to spend a little time to calculate how much you spend. You need to collect all your receipts and write it down. You know, it is a little bit painful to do this because most of us, we have not been used to do that. In school, we never learned budgeting in school. I never learned that, you know. So it is important to write down your expenses, think well about your expenses, and do a little bit of effort because it's worth it. You know, 10 minutes a day, it doesn't need to be more than that. 10, 15 minutes a day, collecting all your receipts, keeping them, writing down in your paper or on the computer or on the phone, write it down and calculate at the end of the month how much you spend. And for example, in my budget that I shared with you, I don't know if you were here when I shared it. Let me share it again. Let me share it again. So when you do that, you will be able to know how much you spend, and if you spend too much, it will tell you, right? So you don't want to spend too much.
Yeah.
Let me just show you here a little bit. Right. So, for example, let's say for groceries, because we're a family of 6, we spend $650 a month. Actually, it's actually $700 a month. Let's say I spent, see, every time I have my receipt in the store, I'm walking out of the store with my groceries, I have my phone with me and I enter the expense. So if I spend 72.13, I enter this, right? Enter. Okay. Let's say for example, I spend $600 in something, then I overspend, then I see it in red and I have to stop. I have to literally stop until the end of the month. I cannot spend a cent more because I overspent here. So I tell my money what to do. I don't let my money control me. If my budget is not big enough for groceries and I see after a few months that I actually spend more than that a month, then I have to adjust somewhere else. I have to spend less. I have to spend less in clothing. I have to, remove the house phone. I have to remove something, because if I spend too much here, I have to adjust so that at the end I still have a budget of balance of $0. So all my money, all my income is listed. All my expenses is listed, and at the end, everything should be 0. If I have extra money here, then I need to put it for savings or for paying off debts. And so when you do your budgets, you can do it like me. I like a lot of precision and details and so on. But you don't need to do all of that. You can have those bigger sections only, like mortgage, groceries, gas. See, for restaurants, we used to go to restaurants before, when we didn't have a budget. So we went to restaurants maybe once a month, something like this. And we spent a lot of money. We didn't realize that, you spend $100 easily with 6 of us in the restaurant. So now we put $20 a month, which is not enough. And every 5-6 months, then we go once to the restaurant, special outing, right? So we lowered our budget there. We lower our budget for different things, so this is you make your plan, and I hear a lot of noise coming from your phone.
Sorry.
Yeah, so did I answer your question?
I understand.
Okay.
Yeah.
Anyone else has a question? All right, if not, then we'll close. Let us close with a prayer as well. Let us pray. Our dear Heavenly Father, Lord, thank you so much for helping us decide wisely on the best things for us, and help us to plan on the long term, counting on you, but also doing our part so that we are wise. The Bible tells us that we should take care of our household first. And Lord, we ask that you may help us to be wise, not spend all our money when we get it, and have the habit of planning and saving. Lord, I ask that you may help those that are struggling financially, that you may help them to be wiser with money and to budget well. We ask, Lord, everything in the name of Jesus. Amen.
Thank you so much, Brother Etienne, for this. And I just want to add something.
Yes.
So maybe in the beginning, it's easier for some people to work with cash. For example, my wife, we just planned for 1 month, $400 for grocery store, and you cannot spend more than you have, right? So if you don't have money, you cannot
Yeah,
spend
take
more.
cash out. That's right.
But when you have a credit card, it's easier to to spend more. So I think one of the way, it's just in the beginning of the month, just put apart how much you want to spend for grocery store and just use those money, and that's it.
Yes, that's a very, very good point. I used to do that at the beginning. Now I'm more experienced, but I used to do that. I withdraw cash, and then I have the cash I have my wallet in the envelope. And when I go to the grocery store, I spend, and then I know that I have, and when you spend with cash, you actually spend less because you see the money physically in your hands. The credit card is just numbers. Our brain is not meant to think with numbers so much. But when you have a cash, for example, if you have a $50 bill or a $100 bill, it's painful, right? It hurts. You go to the grocery store, you get that $100 bill, it hurts. But when you swipe your card or you just tap your card, you don't think about it, right?
So I still remember what you told me. If something is $1, if you have $100 bill, you're not gonna buy it.
Yes.
Because you don't want to. But if you have a credit card, you're gonna buy it. It's $1. It's okay. You buy it with a credit card. That's so right. I think in the beginning, for some people, maybe it's easier with using cash.
Yes. Very good point.
It's visible. You can see it. You can plan from the beginning of the month, at least for not so details as you have it, maybe. But at least you can, for grocery or for, just put apart 500, 600, depends how much you are doing it. And you can see at the end of the month if you can do it or not.
Exactly. Good point. Thank you so much, Brother George. All right, then I wish you all a good night, and we'll see each other next Monday at 7 as well.
Thank you so much, Brother Etienne. Thank you, all of you, and see you next time with God's help.